welcome back to another video. This one should be very interesting since I will be going over all the kinds of lags that you will see on the market and also a little bit about market structure and overall how you should be viewing the bigger picture before looking at the 15-minute time frame in order to place a trade. So let's start by identifying how many lags are there and what kind of lags. So on the 5-minute chart mostly, and anything lower than the 5-minute chart, you will see nano lags. And after the nano lags, we have micro lags. And after the micro lags, we have mini lags and macro lags. So this is very important to know. Most of the time, the micro lags will reside on the 15-minute, nano, anything lower than 5-minute. Mini lags, you'll see it between the 1 hour and 4 hour. And on the daily and bigger time frames, you will see the macro lags. As you guys know, I don't focus so much on anything bigger than that because I am a day trader. If I was to place a swing position, I would definitely look at the weekly, monthly chart. But in regards to day trading, it doesn't affect me whatsoever. All right, so let's start going over the market structure and overall how those lags develop. So you have a trend, for example, making higher highs, higher highs, higher highs. All right, so if you notice this channel that it has created right here, most of the time channels would have 3 rotations before breaking to the opposite direction. That is something very useful to know. And inside this channel on the 15-minute, what you see here are micro lags. These are all micro lags. All right, so if you want to go deeper and if you're going to go into the 5-minute chart, inside these lags here, what you're going to see are nano lags, which are not very important to me. So inside those lags are nano lags. The bigger picture are micro lags. And then if you notice after a retracement and then going back up towards a larger picture, what you're going to see here is actually a mini lag and so forth. So there's always lags inside of lags, and that is how the market works. And keep in mind that everything in the market or with the charts are fractal. So whatever you see on the lower time frame is the same thing that you're going to witness on the higher time frames as well. So now let's go over certain channel rotations. I want to go over that again because I think it will clarify when it will be the time for a market to maybe reach a pivotal point on the higher time frame and how does it actually work. So going back to the first example, you will be on a trend making higher highs and higher highs. All right, most of the time, like I just mentioned, you will see 3 touches on the top side or on the resistance area. You will see 3 touches before it goes the opposite direction. All right, and the same thing vice versa. Also, another key thing that I would like to go over is whenever you reach a certain pivotal point, which it will be, you will be able to identify the pivotal points by going at the longer time frames. So when you're looking at the longer time frames, you will be able to spot on the 4-hour chart, you see a 79 short, and on the 15-minute, you actually took a 62 long. So if you took a 62 long as your trade is developing, you know that if you go to the 4-hour and you play devil's advocate, you might probably see resistance around that price. So you pay attention on the 15-minute and you could take profit around that price because that's going to be a possible pivotal point. Once you witness a pivotal point and the market returns to reach an objective going the opposite direction, this is very good to know that most of the time what you're going to see is this is what you're going to see. Once it reaches a pivotal point, and again, like I mentioned, going long or short, you're going to see first a 38% bounce first, and then you'll see a 62 bounce. So keep an eye on the scenarios. Keep an eye on the scenarios. You had a trend going bullish. You probably took this fib trade here. You took profit at the pivotal point, and then now you're waiting for the EMAs to cross here in order for you to run your fibs going short. And keep in mind that once you see market structure break to go the opposite direction, to go short, you would most of the time see first a 38 bounce. After the 38 bounce, then you will witness a 62% bounce. So now let's do it going the opposite direction, just for clarification. You see the market structure going down, and then now we're going long. All right, you wait for your EMAs to cross, and if you run your fibs, you will notice that the first bounce is a 38. After the 38 bounce, the second one is a 62. So how can you capture the move without losing out on all these pips down here? Because if you think about it, you'll be sitting on your hands until you see the 62 retracement. So you're going to miss out on all the pips in this area. So one thing that I can mention in order for you to not miss out on those pips, because the trend has already been established once the EMAs cross and the market structure breaks to the upside, is look at the 5-minute chart setup. And this is where the magic happens. So let me go ahead and delete this. All right. So if you look at the 15-minute chart, you will see a 38 bounce. However, on the 5-minute chart, you will see a 62 bounce because the leg will be created at a higher pivotal point. All right. So this is where it gets a bit challenging, and when you're able to use the 5-minute chart. On the 5-minute chart, you will see a 62 bounce in sync with the 38 bounce on the 15-minute chart. That gives you confirmation that you're able to take a long here. And it gives you confirmation that once it hits a major pivotal point on the 15-minute, you're able to take most of your positions off to pay yourself and then leave a small position running, because most often than not, you're going to see a 62 bounce and then it'll keep on going up. So as it has that retracement, you still want to be in the trade, just have a smaller position. And that's exactly how it works. It is very simple. Just practice it on your chart, go over back in time, do some back testing, and you will see it unfold all the time. I would say that happens about 90% of the time on major pivotal points. So that is something very, very crucial to know. If you have any questions in regards to this and how it works, feel free to send me a DM or write in the community chat. Most of the time, you will see 3 touches to the resistance area. And then you can also see the 4th touch, which is not so common, but you can see a 4th touch. And also you can just see the channel break. The bottom of the channel becomes resistance, and then it goes the opposite direction. And also it can break, test the bottom of the trend, but then continue being bullish. That's how it traps all the shorts that it had accumulated on that pivotal point. And this is why I like using the EMAs, because the EMAs, once they cross and you see market structure break, they give you a very good confirmation that the trend has shifted. It's more than enough confirmation. And then that's when you see the 38% short. Certain people, they like to trade channels, but they do it with minimal confirmation. For example, they see that the trend is bullish right here. It breaks the channel, it tests the bottom of the channel as resistance, and then they want to take a short right there. But that's not enough confirmation in order for you to take a short. Be mindful that the overall trend is still bullish. So there's no way for you to counter trend to that degree. It's best to just wait for market structure break, wait for your EMAs to cross, look at the 5 minute on the first pivotal point so you can see the 62 short on the 5 minute and see the 38 short on the 15 minute, and that is a confirmed entry for you to go short.